If you're looking to raise capital, investor money for a multifamily deal, or if you're looking to passively invest in an apartment deal, you're going to come across common equity and preferred equity. But what do they mean? Like, what's the difference between the two? That's exactly what I'm covering in today's video. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it, answering the question, what's the difference between common equity and preferred equity? These two terms are very common in real estate syndications and funds. And if you're interested in learning more about that, I'll put a link right up here to a video I did explaining all about the difference between funds and syndications. But that's not what we're talking about today. Today, we are focusing on common equity and preferred equity. And to answer the question, what's the difference between the two, we have to go to something called the capital stack. So let me draw the capital stack right here. And the capital stack is a really useful thing that we use, an illustration to really tell us about the risk involved and who gets paid first in a real estate deal, how everything stacks up. So let me start off very simply here. So we've got two parts to the capital stack. Down here we have debt, so the money lent to the project, and then up here we have equity. Now, obviously, with the debt, it's money lent to the project, so there's no ownership here. So a lender will lend debt. We're not going to get into mezzanine debt and senior debt and all that stuff. You just have to know down here, the bottom part of the capital stack is debt. And when we're looking at the stack, the bottom gets paid first and then it goes up and up and up. So debt here, whoever has the mortgages, the loans on the property, they get paid first. But also the return is lower on the bottom because there is less risk because they get paid first. And as we go up the stack, the risk goes up, but also the potential returns because you have that risk and reward. Now, in the equity portion here, this is the ownership of the project, right? This is where you actually own a piece of the project and then you get to participate in the upside. This is a great balance between the risk and reward, right? Down here in the debt, you're getting paid first, but you're not participating in the upside. You're getting paid, the lender's getting paid back X percentage for the privilege of you using their money. With equity, you can really build something and participate in the upside of the deal. Now, this is where we get into the two types of equity. We have common equity and preferred equity. And the way they stack up here is, let me draw a new capital stack right here. So we'll have debt down here. And then we'll have common equity. My writing hasn't disintegrated or gone to shit yet. So we'll go, hopefully it lasts. Okay, common equity, and we'll have preferred equity. Often called like pref equity. So you'll see that preferred equity is lower on the stack than common equity. So that means that as things get paid, the debt gets paid, and then preferred equity gets paid, and then common equity gets paid last. So if we're looking at risk, common equity carries the highest amount of risk because they are the last people to get paid. But when we're looking at a syndication or a fund, any type of deal structure like that, first of all, we have to figure out, well, who's making the decisions in the project? Like who's steering the ship here? And that's going to be the common equity. So we'll have voting shares. And control of these structures is done through shares like I just wrote here. So these shares with the common equity, they're going to be voting shares. So people are going to be able to vote on decisions that the project has to make. Preferred equity will not have that control of the project. They won't have the voting rights. And oftentimes the way this plays out is the common equity is held by the general partner, the people running the deal. They're making the decisions. And then the preferred equity is held by the passive investors. Now, there are a lot of benefits to having preferred equity. And preferred equity really came out of there being a need for what's called an alignment of interest. So aligning the interests of the general partner, the person who's controlling the deal, with the common equity, and then the passive investors, the people funding the deal that owned the preferred equity. And how you merge those interests together, how you align those interests, is done using that preferred equity component. By offering preferred equity, the general partner, the person controlling the deal, they're really saying, hey, look, if you're going to bring your capital to fund my deal, I'm going to give your money, your shares, priority over my interest in the deal, because you're going to get paid first. And also we have something called preferred returns, and I'll put a link right up here to a video I did explaining all about that. But that's a product of preferred equity. So basically what that means in a nutshell is that the passive investor, the person holding the preferred equity shares, actually has to hit targets in terms of their returns before the common equity can participate in the profits. So really when you break it down is, hey, passive investor, I'm offering you X% that I'm going to do every year. If I don't hit that, I don't get to participate in the profits. So it's really aligning the interest and making sure that the common equity holder, the general partner, is really making the property, the project produce the returns that they think it will. To summarize, preferred equity gets priority in the capital stack over common equity, so it gets paid first. And this is going to be offered to passive investors to really align the interest, to make sure through preferred returns that the general partner, the controlling entity, the common equity shareholders are really performing on the deal like they said they would, or else they don't get to participate in the profits. And then the common equity is going to be held by the general partner or partners, the people controlling the deal, and it's going to offer the voting rights so they can steer the project. So like I said, if you're interested in more of the capital stack, going more in depth, check out the video I mentioned at the start where I take you through the whole capital stack and into the debt portion as well. But that should answer the difference between common equity and preferred equity. And if you're interested in multifamily real estate investing, join my free Facebook group, link down right below. And if you like this video, please hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.